The 4% rule is now the 4.7% rule, a retirement lifeline that's evolving. When you think of retirement planning, the 4% rule is likely the first name that comes to mind. But here's where it gets controversial. This iconic guideline, once a cornerstone of financial advice, has been updated to the 4.7% rule. Why? Because the world of retirement has changed, and so has the math behind it. Back in 1994, financial advisor Bill Bengen introduced a groundbreaking concept that would become a household name. His rule suggested that retirees could safely withdraw 4% of their savings in the first year of retirement, adjusting for inflation each subsequent year. It was simple, elegant, and surprisingly effective. Over time, it became a go-to strategy for millions seeking to fund their golden years. But here's the part most people miss. The 4% rule was built on assumptions that don't hold up today. 30 years ago, many savers allocated half their money to stocks and half to bonds, a balance that worked well for the markets of the 1990s. Today, financial advisors recommend a broader, more diversified portfolio. This shift has forced a reevaluation of the original formula. And this is the part where the debate really heats up. Some experts argue that the 4% rule is too simplistic. Others say it's still valid, but with a crucial caveat. The 4.7% rule is the new standard. Why? Because modern investors have a different risk profile, and the stock market has performed exceptionally well in recent years. Bengen, who helped create the original rule, now advocates for a slightly higher withdrawal rate to account for these changes. Let's break it down. If you retire with $500,000 in savings, the 4% rule suggests spending $20,000 in the first year. But with today's market conditions, a 4.7% rate would mean $23,500. This adjustment reflects a more realistic approach to longevity, inflation, and market volatility. However, not everyone agrees. Critics argue that the rule is becoming too rigid, especially for those with smaller savings. The truth is, the 4% rule remains a powerful tool, but it's not a one-size-fits-all solution. For many Gen Xers, who face a 45% chance of falling short in retirement, the original formula may not be enough. As one financial expert put it, the 4% rule was a general guideline, but the reality is people need to tailor their plans to their unique circumstances. So, what does this mean for you? The 4% rule is still relevant, but it's evolving. If you're planning for retirement, consider these questions. Do you have a diversified portfolio? Are you accounting for inflation and market risks? And most importantly, are you willing to adjust your strategy as life changes? In the end, retirement isn't just about numbers. It's about balancing caution with optimism. Whether you stick with the 4% rule or embrace the 4.7% version, the goal is the same: to ensure your savings last as long as you do. What's your take? Does the 4% rule still work for you? Or do you think the 4.7% rule is the better choice? Share your thoughts below. We're always eager to hear your perspective.